I'd say 1% Fed funds. I'd say, what I say, 2.5 to 3 10-year, and $7,000 to $10,000 gold, and 75 to 85 Dixie.
If gold was $20,000 an ounce, that would be about $5 trillion. Gold was $40,000 an ounce. That gets you about $10 trillion. He could literally wade into the Treasury market with that $10 trillion windfall, which is essentially just straight money printing using the gold. We would not have to sell a single ounce of gold to do that. It's just an accounting creation gimmick.
Mounting pressure within U.S. monetary policy is now converging with a broader shift in global liquidity, creating a setup in which interest rates, currency dynamics, and hard asset valuations move far more violently than in previous cycles. Forward projections built around a potential 1% Fed funds rate, sharply reduced Treasury issuance, and aggressive balance sheet maneuvers indicate that gold could be re-anchored dramatically higher. At the same time, the dollar weakens into the 70 to 85 range on the DXY. This environment favors high volatility across assets, rising nominal GDP, suppressed long-term yields, and long-duration demand, forming the backbone of what increasingly resembles de facto yield curve control. Luke Gromen, recognized for connecting fiscal strain, currency behavior, and sovereign funding mechanisms, argues that gold's next move mirrors past phases of debasement. His framework suggests gold reaching $7,000 to $10,000 as structural constraints force policymakers toward aggressive monetary repression. In parallel, Bitcoin's cyclical lag, Nasdaq's sensitivity, and global competition in AI continue to shape trader expectations. However, long-term positioning still reflects a shift toward debasement hedges rather than short-term trades. Now, we present the clips from Luke Gromen's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
If he gets Fed funds at 1, could get that. I wouldn't be surprised if he got that. To me, the $64,000 question then is, where's DXY? Where's gold? Where's a 10-year? If he has rates at 1 by the end of his term, I think DXY's low 80s, high 70s. And I think the 10-year, I think gold is probably $7,000 to $10,000 an ounce.
Wow.
I think Besant has revalued it from 42 to whatever that number is and put multiple trillions of dollars into, $1.5 to $2 trillion, maybe up to $2.5 trillion into the Treasury general account, and significantly curtailed long-term Treasury issuance. So I think the 10-year, if Trump gets his 1%, I think DXY's, 75 to 85, and I think gold's 7 to 10,000, and I think the 10-year yield is at, where's it today, 4? I bet you the 10-year's at 2.5, 3. Because ultimately, I think they're just going to curtail issuance so greatly, and there's like this mindless bid for duration of whatever it is, $400 billion a year, $500 billion a year from duration matching. I could see that, and that's essentially de facto yield curve control. With the dollar weakening that much, it's going to be massively stimulative. Nominal GDP is probably pretty good. How they reinvest depends. How our foreign partners reinvest, it depends. I could see that. That's if he gets his 1%, yeah, that's what I would say. I'd say 1% Fed funds. I'd say 2.5 to 3 10-year, and $7,000 to $10,000 gold, and 75 to 85 Dixie. It is an unenviable situation in which they find themselves, and ultimately, I think it's we started to see more volatility in certainly gold markets, other markets in recent weeks. I think it's a much more higher volatility sort of baseline, and I think it's really good for stocks. It's really good for inflation. It's really good for gold. It's really good for Bitcoin. It's probably continue to be good for certainly certain types of real estate, hard assets, and I think it'll be good for wage earners. But I'm not sure it'll be good for sort of white collar. I think might see a reversal of what we saw from 2001, from 1982 to 2020. I think the next 40 years might be really good on a relative basis, certainly for wage earners, skilled trades, engineers, etc. Even if they're prompt engineers as it relates to to Chat GPT and AIs. But running it hot and repressing bonds is the only way out. My base case is that we've seen this pattern where sort of gold goes and then Bitcoin goes and then gold goes and then Bitcoin goes in the last few years, and I think it's maybe that. I also think part of it is, particularly amongst shorter term traders, Bitcoin is traded with Nasdaq increasingly in the short term. And, the NASDAQ, for a number of different reasons, has kind of been range bound through much of the summer. And I think there are there's reasons to be potentially secularly concerned with the NASDAQ or certain high-flying parts of it, right? Can China win in AI, right? Right now, someone showed me an AI leaderboard the other day, someone in that world, and they said, hey, for what it's worth, this is based on what are supposed to be objective metrics. Top 10 AI platforms, half of them are Chinese, half of them are American, right? So you're spending hundreds of billions of dollars in capital in this country to build that out. What happens if China does to AI in the NASDAQ what it's done to sort of every other industry in the U.S. that it has attempted to do that to? I suspect some concerns around that, some concerns around the capital intensity, et cetera, are weighing on the NASDAQ. Some of the trade war has as well. So I think in the short run, some of what is holding Bitcoin back has just been that, that short-term view that, well, Bitcoin is just NASDAQ, a high beta version of NASDAQ, up or down. And so if NASDAQ's not ripping, there's no reason for me to get involved in Bitcoin. And, there's something to that. Over time, of course, if you go back 5 years, 10 years, they are still they rhyme, but Bitcoin has crushed NASDAQ, right? So, and I still think that'll be the case. But I think those are kind of, and I guess I would layer on one last one, which is, we're to the end of the 4-year cycle on Bitcoin, right? So, 4 years ago was end of 21. We sort of had that last little blip up into the 60,000 range. And then, 2022 was sort of, kicking the crotch after kicking the crotch for Bitcoin holders. And 2017 into 2018, same thing. 2013, 2014, same thing. So I think there's a lot of people that are very cognizant of that and are skeptical that it's different this time, and I think that's a reasonable view. So I think sort of the combination of all those three things are probably drivers to the reason why Bitcoin doesn't seem to be responding. Let's see. I'm still seeing. I would feel a lot worse about Bitcoin sort of being range bound if I was seeing people telling me, what I'm saying, which is they're going to have to repress this thing so much, and there's no way they're going to be able to win against China without running this thing super hot. I'm not seeing that. I'm still seeing a lot of bargaining and wishful thinking and sort of, idea machine, as one of my friends calls it, right? It's well, we'll just, we're going to mine all our mines. It's okay, great. Where are you going to get the turbines? We don't know. Well, the lead time on turbines is 3 years. Okay, well, how about the permitting? Well, we're going to get that. That's normally 4 to 5 years. Well, okay, well, we're going to build a rail yard into those mountains. Great. Where are we getting the steel? Where are we getting the welders? Where are we getting the engineers? Are we going to take them off the AI programs? Or are we going to leave them on the AI program and bring in foreigners that you just closed the border on? So there's a lot of the idea how to do it. That part's easy. There's an executional side that is being sort of, smoothed over by Washington and Wall Street that I would sort of summarize as, other than that, how was the play, Mrs. Lincoln, right?
Right.
Other than the fact your husband was assassinated at the play, how was it? Well,
Great.
That's the whole friggin' thing, right? That's, if you can't execute and put this order of operations together. So let's see how that plays out. When it comes out, and I think it is a win, when it comes out that this isn't going to get fixed in a year or 2 or 3 years or 4 years, that this is, hey, we're going to need to do 10 years of really aggressive investing in inflation. Look, if Bitcoin's down or doesn't do anything on that, that's probably going to force a rethink on my part and a lot of people's parts. But until I see people telling me that, I remain bullish. The Fed is running its first quasi-fiscal deficit, which is just a fancy way of saying operating loss, in its 110-year history. Once Brazil started running quasi-fiscal deficits, once Argentina started running quasi-fiscal deficits, gold and Bitcoin went from sell the rip, debasement trades, to buy the dips, debasement trends. And I think that's sort of where we are, where there's still this view is okay, well, I'm gonna have to get out and at some point and, sell Bitcoin, sell gold for dollars. And for a trade, sure. But really? You want to sell gold and Bitcoin for dollars as we're talking into this setup? Why? It makes no sense to me. And so I think that's still on the come. People will come to that.
Growing tensions within the U.S. monetary system are pushing policymakers toward increasingly unconventional solutions, including aggressive gold revaluation to stabilize federal finances. Repricing official gold holdings, even into the $20,000 to $40,000 range, would create trillions in instant balance sheet liquidity without selling a single ounce, enabling large-scale Treasury buybacks and sharply reducing debt-to-GDP ratios. Such a move would also mirror past cycles where currencies realigned violently against gold, especially when government obligations consumed nearly all fiscal capacity. Structural pressures are now similar. Entitlement costs, soaring interest payments, and a shrinking industrial base are forcing the system toward a reset in which gold becomes the release valve for unsustainable deficits. Allowing market forces to lift gold multiples higher could shift the entire debt structure, support nominal growth, and redirect capital toward essential rebuilding efforts before broader instability takes hold. Let's get back to the interview.
The Treasury Secretary can instruct the chairman of the Fed to revalue U.S. gold. And that would then create a deposit into what is essentially the Treasury's checking account, free and clear. It's called the Treasury General Account, or TGA. Right now, this is important because we still hold the gold on our balance sheet at a statutory rate of $42 an ounce that it was back in 1971. So at $4,200 an ounce, and assuming we have all the gold we say we do, which I think we probably do, but let's just keep it simple. At $4,200 an ounce on our 8,100 tons of gold, today if we revalued the gold, if Besant called up Powell and said, okay, revalue it, Treasury would have a windfall free and clear of about $1.2 trillion deposited into their checking account with which they can do whatever he wants within reason. Now, the problem is we have $27 trillion, the Treasury market's $25 trillion in debt, $37 trillion overall. I think the Treasury market is $27 trillion in size. So that's a whole 4% of the Treasury market. It's not big enough. Now, if gold was $20,000 an ounce, that would be about $5 trillion. Gold was $40,000 an ounce. That gets you about $10 trillion. He could literally wade into the Treasury market with that $10 trillion windfall, which is essentially just straight money printing using the gold. We would not have to sell a single ounce of gold to do that. It's just an accounting creation gimmick. And he could buy back, $10 trillion on $27 trillion Treasury market, $25 trillion Treasury market. That's 40% of the market. Now our debt to GDP is not 120%, it's 80%. And oh, by the way, the monetary multiplier of printing that much money and injecting it essentially into the economy, right? Because if you own treasuries, now you got cash. You're going to spend it. GDP would probably grow 20, 30% for 2 or 3 years. Fed would have to cap rates, but the net of it would be after 2-3 years, we would have debt to GDP of probably 25%, 20%. And now the Fed can act independently, manage the monetary system, etc. Now, I think it's really important. Those numbers sound preposterous. But if you look at the market value of U.S. official gold, just the market price times our 8,100 tons, as a percentage of the foreign held portion of U.S. treasuries outstanding, today, with the massive run we've had in gold, that is at 11%. Now, by way of comparison, in 1989, when the Berlin Wall came down, 20%. So gold would have to almost double just to get back to 1989 levels on that metric. The long-term average is around 40%. So gold would have to quadruple from 4,200 an ounce just to get back to the long-term average. And in 1980, when we had an honest-to-goodness dollar crisis, that percentage was 135%. So in 1980, foreigners could have brought all of their foreign debt to the U.S., demanded gold, taken gold, and we still would have had 35% of our gold left over. That is a gold bubble. Our foreign debt was 135% gold back. Today, it's 11. So now, if Besant revalued it unilaterally, he would have to make that market, I think, which is a whole lot of money creation, and that's tricky. But if they're able to pursue policies that let the market value the gold up to those numbers, for 20%, double from here, 4 times from here, and then did it, that's the market. And there are steps we could take, right? Where, there's nobody better at being a bull in a china shop than Trump, right? He can go in there and start breaking stuff and people go, oh God, I need gold. And if everybody bids up gold for him, they could do it. I mean, that is a way to do it fast. Print the money or trigger the revolution. And that's the choice that Powell's been faced with, which is print the money or trigger the revolution. It's what the Western central banks, all these central banks are faced with: print the money or trigger the revolution. What do I mean by that? The United States, which I focus on, number one, that's my area of expertise. Number two, it's the center of the system. We're the reserve currency issuer. The Treasury bond has been for 50 years the primary reserve asset of the entire system, which means Treasury bonds back the banking system across the West. When we look at the United States, we have record treasury receipts of about $5.5 trillion. We are spending about 70% of that record receipts on entitlement payments to the baby boomers and the silent generation. And yes, they earned some of that, but they didn't earn all of that. They are taking out way more than they put in nominal terms, by far. And then you look at the rest of that $5.5 trillion, 70% is going to entitlements and about 30% is going into interest. So we are literally spending 100% of all-time record receipts on things that are interest or interest-like obligations, right? There is very little functional difference between the German war reparations after World War I that had to be paid in gold, and so the Germans, it was not a currency the Germans could issue, and entitlements to the baby boomers and silent generation. We don't owe them dollars. We owe them hips. We owe them knees. We owe them pharmaceuticals. We owe them dollars time, all of which are inflation adjusting, just like gold was. The more money we print, the more the cost of those entitlements, that off-balance sheet debt's going to rise. Well, the inflationary systems always end. You either have to voluntarily get away from it, or the currency system has an issue. And what we're talking about is the currency system collapsing against gold. And 100% of fiat currency systems in history always end by collapsing against gold. Like this at least allows us to redirect, right? If Besson ends up with $2 trillion, $5 trillion, $10 trillion, now he can go, okay, we are going to subsidize an education program for the skilled trades. We are going to build up a new generation of young farmers. We are going to rebalance the economy. We're going to build productive assets, whether that be farmers, welders, industrial capacity, the electrical grid, with some of this money. That's a good outcome. Is it inflationary? Sure. Do bondholders get killed on a real basis? Sure. But that's in the cake. That's the good outcome of the currency collapsing against gold. The bad outcome is you pretend like none of this is true, and you don't proactively do some of the things I just said. And then when the currency collapses against gold, you have no ability. You have no ability because when people are scrounging for food or whatever, they don't go to work, right? This is like a Russia 1998 type scenario, right? It takes you a long time to rebuild from that in some sort of leader. So, and that's a situation, that's a really bad outcome. And that's, I wish these weren't our options, but I really wish we wouldn't have gone to Iraq on a lie. I really wish we wouldn't have offshored our industrial base and subjugated the U.S. middle and working class for 40 years to support the bond market and Wall Street. And I really wish we wouldn't have bailed out fraud in 2008, which is what we did. And I really wish we would have been more strategic with how we handled COVID. But I didn't make those policies, right? So those are in the cake, and it's it's not some sort of happy thing. And I guess, why are you smiling then, Luke? Sometimes when you want to cry, all you can do is laugh.
The broader macro landscape is shifting toward an environment where policy, debt management, and currency stability depend heavily on reactive measures rather than long-term planning. Rising volatility across gold, Bitcoin, and the bond market reflects a system moving toward structural repricing. As policymakers explore tools such as aggressive revaluation of official gold reserves, the implications stretch far beyond short-term stimulus. These moves reshape debt sustainability, foreign confidence, and the future purchasing power of the dollar. The growing divergence between financial engineering and real economic output reinforces the likelihood of significant adjustments ahead, especially as global competitors advance rapidly in technology, energy capacity, and industrial expansion. Hard assets continue to anchor long-term wealth preservation strategies as traditional instruments lose reliability during cycle transitions. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.